Welcome to CoreLogic's housing market update for June 2022. Housing markets lost more steam in May as a combination of higher interest rates, rising inventory levels, and lower sentiment dampened conditions. CoreLogic's Home Value Index showed Sydney and Melbourne dwelling values continued to record the most significant month-on-month falls, while Canberra recorded its first monthly decline since July of 2019. Although housing values continue to rise across the remaining capital cities, the growth rate wasn't enough to offset the depreciation in Sydney, Melbourne and Canberra, which pushed the combined capitals index 0.3% lower over the month. Elsewhere, growth trends remained positive in May, albeit with less momentum in most markets. Perth and Adelaide were the exceptions where the quarterly growth trend lifted in May, although both regions remained below the peak quarterly rate of growth. While the higher cash rate and lift in variable mortgage rates in May played a role in the weaker housing values, it's important to remember that conditions have been weakening over the past year, at least at a macro level. The quarterly rate of growth in national dwelling values peaked in May of 2021, shortly after a peak in consumer sentiment and a trend towards higher fixed mortgage rates. Since then, housing has been getting more unaffordable, households have become increasingly sensitive to the higher interest rates as debt levels have increased, savings have reduced, and lending conditions have tightened. Add to that rising inflation and a higher cost of debt, and it all flows through to less housing demand. With the trend of growth easing across most regions over the past year, the annual rate of change has eased sharply over recent months, dropping to 11.7% across the combined capital cities, down from a recent peak of 21.3% over the 12 months ending January of 2022. Although regional Australia continues to demonstrate stronger growth conditions, it's also come off peak growth rates, with the annual growth trend easing to 22.1%, down from its January peak of 26.1% and likely to trend lower through the rest of the year. As the pace of growth eases across most regional markets, we're likely to see growth conditions softening in line with higher interest rates and worsening affordability pressures. Arguably, some regional markets will be slightly insulated from a material downturn in housing values due to ongoing supply and demand imbalances, as we continue to see advertised stock levels remain extraordinarily low across regional Australia. A combination of higher interest rates, housing affordability constraints, diminishing household savings, and lower consumer sentiment has also had a negative impact on home sales. Nationally, our estimate of settled sales over the 3 months to May was 19.2% lower than at the same time last year. The figures remain 12% above the previous 5-year average. However, it's likely housing turnover will continue to trend back towards average levels as interest rates normalise. Lower sales volumes are being accompanied by a gradual rise in advertised stock levels. Nationally, advertised inventory is 10% below levels from a year ago, but buyers in softer markets like Sydney and Melbourne have more choice and less urgency, and better leverage as advertised stock levels rise to above average levels. While housing value growth has slowed, rents continue to rise swiftly. Nationally, CoreLogic's Hedonic rental index has increased by 1% in May, taking the quarterly rate of growth to 3%, up 60 basis points on a year ago. Rents are up 8.8% in the past year across the combined capital cities and 10.8% across the combined regional areas. For investors, yields are recording some upwards momentum amidst rising rents and a general easing in home value growth, especially in Sydney and Melbourne. Despite the upwards trajectory, yields remain remarkably low, but a recovery back to average levels may happen sooner rather than later if housing values continue to be outpaced by rents. Sydney housing values moved through a 4th month of consecutive declines, with the magnitude of falls gathering some pace. Values were down 1% in May, taking the market 1.5% lower, or roughly $17,300 down on the January peak. As the market moves into the early phases of a downturn, sales activity is also fading, with sales activity over the past 3 months estimated to be down by 1/3 relative to the same period a year ago. With a slower rate of absorption, advertised stock levels have normalised and are slightly higher than the 5-year average. With more stock to choose from, homes are taking longer to sell, discounting rates have risen, and auction clearance rates are trending at below average levels. With conditions gradually favouring buyers over sellers, vendors may need to adjust their pricing expectations in order to meet the market. As interest rates normalise over the next 12 to 18 months, the expectation is most of Australia's capital cities will move into a period of decline brought about by less demand. The trajectory of interest rates will be a key factor in future housing market outcomes. Forecasts for where the cash rate may land are varied. After the Reserve Bank's May board meeting, the governor noted a cash rate of 2.5% wouldn't be an unreasonable expectation. Financial markets are still betting on a cash rate above 3% before mid-2023, while economic commentators show a broad range in their cash rate forecasts. With the housing debt-to-household income ratio at record highs, household balance sheets are likely to be more sensitive to rising interest rates. High inflation could be another factor contributing to softer growth conditions in the housing sector. A prolonged period of high inflation is likely to lead to lower rates of household saving and may potentially weaken prospective borrowers' ability to meet serviceability assessments from lenders. Consumer sentiment also remains low. Historically, there's been a strong correlation between consumer attitudes and housing market activity. These factors, together with stretched housing affordability and a more conservative approach from lenders, especially towards borrowers with high debt levels, are likely to contribute towards less housing demand over the medium term. However, there are several mitigating factors to consider as well. Labour markets are tightening, sending the unemployment rate to generational lows and placing additional upwards pressure on wages growth. As income growth outpaces housing values, the home deposit hurdle will gradually lessen, reducing one of the key barriers to entry for home buyers. Strong labour market conditions together with a growing economy will help to contain mortgage arrears and mitigate some of the risk of a surge in forced sales, placing additional downwards pressure on housing values. Mortgage stress should also be minimised to some extent by mortgage serviceability assessments at the time of the loan origination. All borrowers have been assessed under a mortgage rate scenario at least 2.5 percentage points higher than the origination rate, and since October last year, borrowers were being assessed with a buffer of at least 3 percentage points. Under these serviceability scenarios, it's reasonable to expect borrowers should be able to accommodate higher mortgage repayment costs, although such a rapid rate of inflation could create some challenges for borrowers with thinly stretched budgets. With the RBA set to steadily raise the cash rate through to the end of the year and into 2023, we're likely to see falls in housing values becoming more widespread as mortgage rates trend higher. As these trends evolve, we'll be keenly reporting on all the twists and turns in the market at the research pages of CoreLogic.com.au.